I asked Claude the top 3 pieces of advice rich people give about building wealth. The answers were actually pretty good, but they were missing the engine that makes the whole thing work. And that gap could cost you a huge amount of money. Like on $1 million, it could be $250,000 over your lifetime. So let me show you exactly what I mean. Here's what Claude said, and here's the exact prompt. What are the 3 most common pieces of advice given by rich people to folks trying to gain financial independence? Claude's answer, number 1, pay yourself first. Automate savings and investments before spending anything else. Rich people consistently prioritize building assets over lifestyle spending, often saving, investing 20 to 50% of income rather than whatever's left over at month's end. Number 2, make your money work for you. Invest early and consistently. Whether it's index funds, real estate, or business ownership, the core message is that earned income has a ceiling, but invested capital compounds. Time in the market beats timing the market. Number 3, avoid lifestyle inflation. As income grows, keep expenses flat or grow them slowly. Many wealthy people, Warren Buffett being the classic example, maintained modest lifestyles long after they could afford not to. The gap between what you earn and what you spend is what builds wealth. And then it added, the through line across all 3, the average person spends first and invests the rest. Wealthy people invert that habit. In other words, they invest first and spend. From your perspective, advising clients at Anderson, Claude does know who I am, you probably see this play out constantly. People with high W-2 incomes who are still paycheck to paycheck because spending kept pace with earning. So these 3 tips, they're not wrong, but they are kind of like being handed a map with no car and no gas, right? The destination is right, but the instructions are incomplete. And I'm going to explain how this works. I'm going to use a study. Dave Ramsey, for example, studied over 10,000 millionaires. Teachers were the profession with the 3rd largest group of millionaires in the United States. Not tech executives, not hedge fund managers, teachers. The common thread was an income. It was behavior and system. In the case of teachers, it's pretty interesting. The reason that they were so many millionaires is because they used their retirement accounts and they set it and forget it. We'll get back to that. There was a massive study called I'm going to probably mispronounce it, Dundin study, and it followed 1,000 kids from birth on out. And I'm going to say the study really showed up at age 32. But it's actually longer than that, measuring IQ, family wealth, and social class. Do you want to know what the single greatest predictor of financial success was? In fact, stop. Guess. Put it down in the comments. What do you think the number 1 predictor of success was? Was it being born to really smart parents? Was it just being really high IQ? Was it being born to a rich family? What do you think? Put it down in the comments. What do you think is the number 1 predictor? The number 1 predictor was self-control. It's crazy. They could predict at age 3, and this held true across all lines, whether you came from a rich family, a poor family, whatever. Your success in so many areas of your life came down, they could predict it at age 3, depending on your amount of self-control. Now, you could get better self-control later, so like you could learn it. But at age 3, they already knew, do you have self-control? And if you did, you were going to have great outcomes. So this video is about giving you the system that makes self-control pay off. Now, what did AI say? It said save consistently, automate it, which is smart, prioritize saving over spending. Great. My rebuttal would be, right idea, AI, wrong accounts. Right? The wrong account can cost you over, on $1 million, $250,000 on the exact same investment. Why is that? Because there's 2 tax systems in the U.S. Most people earn money, pay taxes, and then they save whatever's left in like a regular savings account, or maybe they open up a brokerage account. The tax code was specifically written to reward people who use the right accounts. So let's just say let's say I'm doing $5,000 and I'm investing it in SPY or VOO, the S&P 500. Completely different outcomes depending on where that money lives. Did I put it in a Roth IRA? Did I put it in a traditional IRA? Did I get a deduction for it? Did I do the HSA? Is it in a business? Is it in my name? Is it in just my personal name? The IRS built you a wealth machine. Most people just aren't using it. So let's walk through some of our options. In the most common one, taxable brokerage account, maybe taxable savings. I'm going to use brokerage because I'm just going to use the S&P 500. Because on average, it's grown over 10% a year. So I'm just going to say 10% a year. If you buy and hold something like SPY or VOO, that's Vanguard's S&P 500, and do nothing, there's almost no annual tax drag. If I put just after-tax dollars into it, I didn't get a deduction, that stinks, but it's not horrible. The ETF structure, which is what these things are, which is just a bucket of stocks, it's the biggest 500 companies. You're not getting hit with capital gain distributions every year, but when you sell, if you're in a taxable account, you're going to be paying long-term capital gains rates. Generally, they're going to be 15 to 20% long-term capital gains rates on everything you made. The growth is good. You're not getting hammered as you go, but the exit gets taxed. So let's say you did 500, I'm just going to write this down so you get it. I'm going to use an assumption of $5,000 a year for 30 years at 10% per year. I'm thinking if there's anything that I'm missing, and I'm not going to do, and I'm going to say that you're making $75,000 as a single person. I'm just going to grab a rando, right? I'm just going to say this income. Am I going to adjust it for inflation? No, I'm just going to use those raw numbers. So on that money, if it compounds, it's going to be somewhere in that $900,000 range. And if you have to pay tax when you sell it, that's going to be between $135,000 and $180,000, right, walking out the door on your way to retirement. Then that's really not even a rounding error. If we have 900,000, it's 20%, that's 180,000, right? Pretty easy to calculate. Now, what if I put that in a traditional IRA or 401k? Well, you got a tax deduction going in. Real money back in your pocket today. And it grows with no annual tax drag, even if you're doing a bunch of crazy stuff. And I'm just using SPY. Like I'm not getting into a whole bunch of tax that's being incurred as you go along, because that would really hammer the taxable account. It would be great for the IRA. But the tax bill there comes at withdrawal and it comes at ordinary income rates. So you got the deduction today, but you paid the bill on retirement. And I'm just going to point out, if I get a deduction here and I'm making $75,000, I'm in the 22% tax bracket. So how much is that deduction helping me? That's an immediate $1,000, a minimum, a year that you are getting. But we'll talk about that in a second. Then we'll look at like a Roth IRA. You get no deduction going in, but it compounds completely tax-free, and it comes out completely tax-free. There is no bill at the exit. So, hey, I don't get a deduction. It's going to be worth 900 grand someday, but I don't have to pay any tax on that, which is fantastic. No deduction, no bill in retirement. Every dollar of growth is yours to keep. Now, point out one that you may have missed. HSAs. This is huge. You get a deduction going in, just like the traditional, and it grows tax-free, just like a Roth, and it comes out tax-free so long as it's used for medical expenses, just like a Roth. The HSA is the only account in the entire tax code that captures everything. A deduction going in, tax-free growing, tax-free coming out. Most people either don't have one or they're just letting it sit empty. After age 65, by the way, it works like a traditional IRA if you don't want to use it for medical expenses. That's the worst case. It's actually a retirement account. The best case, every medical expense for the rest of your life comes out completely tax-free. And it can do a bunch of other stuff. Like it can pay for your Medicare premiums, and it can long-term care. Hey, I want a new hip. I could pay for that too. But let's do a deep dive. We'll just do a deep dive on traditional IRAs and Roth, because this gets a lot of press, right? So I'm just going to say $5,000 a year for 30 years. Let's just assume you started at age 35 and you're going to retire at 65. So you did 30 years. It grows at 10% return per year, and I'm $75,000. I'm just making it static. Your current tax rate here is 22%. And that's going to be important. When you retire, I'm just going to say 12%, and some of you guys are going to lose your mind. The average retirement tax, do you want to know what it is? It's less than 6%. It's like 5.7. Now, if I did this, $5,000 a year for 30 years, that's $150,000 I put in. My traditional IRA value at retirement, I'll just write this right here so you see it, because this is going to be something that you may not even believe me, but you can just go run your numbers if you feel like it. I'll put up the Voya number where I actually ran this. The traditional value is $925,000 plus some change. The Roth was at $904,000. I know. Some of you guys are like, wait a second, Toby, I heard that Roth is always better. No, in this case, the traditional wins by $20,000 because I am calculating if you reinvest the tax savings. Both accounts grow to the same, let's say 900 grand before taxes. The traditional actually gives you, when you really add it up, it ends up over $1 million in tax savings, but you're going to owe $108,000 at withdrawal. So the net result is that why it's up, because it's actually going to be a lot bigger. It's going to end up being 100 or over $1 million bucks. But there's a tax when you take it out. So I just said, hey, using these assumptions, if I'm paying tax as it comes out, let me just be fair. I just want to make sure that I'm comparing apples to apples. But here's the catch. When you're getting that deduction of that $5,000 per year and it's saving you $1,000, you actually have to reinvest those tax savings. If you spend that refund, the Roth wins. And this is where that self-control shows up again. So again, low taxes now, and I'll just say this as a general rule. If you have low, like you're really in a low tax bracket, and I mean below 20%, the Roth is almost always better. But if you're over 20%, statistically, that traditional is almost always going to be better. And I know your accountant is telling you something different. Facts don't care about your accountant. They're facts, and facts say, all things being equal, you're better to take the deduction when you're making decent money. And then, hey, if I have to pay tax later, but if that tax rate's really low, who cares? Oh, what about Social Security and everything else? Tax rates are tax rates. Numbers are numbers, right? This is so, and yes, you can do conversions when you're in a low tax bracket. If you really get like Toby, oh, that Toby guy 30 years ago, he really messed me up. I ended up with $1 million in an IRA, traditional IRA. I'm so mad and I'm not making much. Or I'm going to have required minimum distributions and it's going to make me have a bunch of tax. Okay, before you do that, in that no man's land before you retire or when you retire versus when you take required minimum distributions, maybe you're doing conversions from a traditional IRA to a Roth. All right, get over it. But then we look at these two. What about the HSA? Ooh, that HSA, you get the deduction. It's really like it lives on its own in the tax code. It captures the deduction going in just like the traditional IRA 401k, which means there's an extra 100 grand. And whether it's Roth or traditional, it literally, using the HSA would make you a millionaire just with the HSA. It grows tax-free like the Roth, and it comes out tax-free if you're using it for any medical expense that you incur after the point you set it up. So like I did a video on this, by the way, like I'll try to put a link there. If all you do is just keep track of all your medical expenses out of pocket for the rest of your life, keep them in a folder, that HSA can reimburse that 30 years later. So even I have an expense now, I'm not getting to write it off now, but in 30 years, I'm going to use it so I can get tax-free money. Congratulations, that's an HSA. But worst case scenario is that it functions like a traditional IRA once you hit 65. So if I have non-medical expenses, I just pay tax on that portion out. Otherwise, I would use it to pay, I mentioned this before, Medicare, long-term care, knee replacement, hip replacement, whatever you wanted to get that's medical, I can use it. So worst case, it's just a retirement account. Best case, every medical expense for the rest of your life comes out completely tax-free, and I can wait and I can pay it. But all that stuff, we're getting way off. I want to get back to a different concept, which was what that Dunedin study showed, which is self-control. Kids with low self-control were less likely to save. They had a lot of credit problems. They had fewer retirement accounts, and this was regardless of income or upbringing. Traditional IRAs, 401ks, the employer-sponsored plan that gives you the same benefits as an IRA, like a DB plan, cash balance plans, all of these come with deductions that reward you if, and this is a huge if you reinvest the savings that you get from the tax deduction. The Roth and HSA build the discipline in automatically because they're automating contributions. It removes self-control from the equation entirely. You don't need willpower. You just need to set up a system where it's just automated. And that goes whether it's traditional IRA, HSA, whatever. Set it up once, automate it, and then go out on your own. Like, forget about it. Set it and forget it. There's an old joke that I say, hey, here's a wealth hack, right? Set up an account, set it to automatically invest, and then lose its password, check back in 30 years. Right, so it's automatically investing in something, maybe, again, I'm just saying VOO or SPY. It's automatically pulling money out of your account. 401ks do this with employer plans. Maybe you're doing this to a Roth, maybe you're doing this to an HSA, maybe you're doing this to a traditional IRA, maybe you're doing it to a bunch. But it gets you out of the way. Just let it do its thing. Don't overthink it. Study after study shows this to be true. But let's go back to AI's answers. So it said, pay yourself first, automate it. I agree with that. Number 2, make money work for you. And this is a good one. Invest in index funds, stocks, real estate. Time in the market beats timing the market. I would say this one's really good by Claude, like it's closest to right, but it doesn't tell you how. So I'm just going to give you a few general rules, like the rule of 72. Here's a really simple one. Let's just say I take, the rule of 72 is simple. If I divide 72 by the percentage rate of return, that tells me how often my money will double in years. So in this case, every 7.2 years, your money is going to double. Wow. So if I'm any percentage that I'm making, I can figure this out. And I like doubling. And that's an easy, rich people way to think. I just want to double every 7.2 years. So 14 years, so if I have whatever money, $20,000 that I managed to get into account, and I do nothing else, but it's sitting in the S&P, chances are, or SPY or VOO, chances are in 7.2 years, that's 40,000. And by 14 years, it's probably going to be 80,000. And by 21 years, that's going to be 160,000. And by 21 years, or again, you can just keep going through your stretch and say it keeps doubling, doubling, doubling. Now, your savings account that you're putting money into, it's not saving you. It's slowly losing you money. Like, this is the problem with savings account. The bank uses your money to do this, and it's paying you, you're basically trying to beat inflation with that. So remember what what it looks like. Compounding looks like this. It slowly and then just takes off. This being time, this being money. So you want to have as much money in that market as humanly possible so you can get into where it goes up like a hockey stick. And that usually is 20 to 30 years. And this is also why it's true that most people quit way too early. The magic is staying in the market and getting out of your own way. There is also the truth, SPIVA data. It tracks the S&P active fund managers against just the index, the S&P. And after 15 years, this is professional money managers versus just buying an index. Anybody want to guess how often the fund managers beat the index over a 15-year period? Like, these are people being paid to manage money. How often do they actually beat the index? It's about 10% of the time. The index wins out over 90% of the time across virtually every category. And the active money managers, these are people with Bloomberg terminals, research teams, MBAs from Harvard, the best schools of the world. But they can't beat a simple index fund consistently over time. And I know a lot of you guys are going to say, well, why would I pay anybody? Financial advisors do a lot more. So I'm just going to say that. You still want to have one. That's one of the buckets. But if all you were doing is just playing it like, hey, I don't want to learn everything. I just want to put money aside, which is, by the way, why teachers have been so successful. Somebody else is just basically sitting it in a fund. But if you didn't pay somebody a whole bunch to manage it, you just set it and forget it, you're probably going to win out like a huge success, like a big percentage of the time. I know a bunch of fund managers out there are mad at me right now. I understand that there's other things that you do that adds value, but I'm just saying, when I just look and say, hey, if you got a 30-year time horizon, you could do a lot worse than just putting it in an ETF following the market. And that's what data tells us. Number 3, diversification done right. And AI keeps saying under there, hey, invest in multiple various assets. Most people interpret that as, a lot of times they're saying, hey, what about picking in individual stocks and diversifying that way? Well, I'm going to say that I wrote a book, Infinity Investing. And it's a lot more than just about picking individual stocks. It's about building buckets of different types of assets. And it teaches the framework for building across different asset classes. Maybe it's index funds. I like income-producing stocks. I love dividend kings. I love real estate that's cash flow. I love tax-advantaged accounts, so that we're not dependent on any single market. The goal is a portfolio that runs while you sleep. Because be real, most wealthy people, they don't watch the market every day. They build systems and let time do the work, and you can too. And by the way, the Infinity Investing, I'll tell you how to get it absolutely free. All right, point 3, and I'll do that a little later on. I'm going to tease you a little bit. Point 3, what AI said: as income grows, keep your expenses flat. Avoid lifestyle inflation. And I would say that's good advice, but most people are already behind when they earn their first real paycheck. And then it gets worse, not better. Like, they're already in debt. Most people start in a hole. In fact, let me ask you a question. For all you adults, anybody that's in their 20s, 30s, 40s, how much debt were you carrying when you were 18? Got out of high school maybe, hadn't gone to college yet. If you want to, maybe do the same thing, say at 22, and just be honest. Are you better now, or are you worse as your income went off? Right? If at 18, I didn't have any debt. I don't know about some of you guys, maybe. I hadn't gone to college or anything like that. When I went to college, I couldn't afford it anyway. So luckily, I played soccer and I got a scholarship. That was the only reason I went to school. But it wasn't something that was in the cards for somebody like me. But I see people all the time that had no debt when they were 18, and when they're 45, they're worth a negative amount. They have so much debt, a bunch of credit card debt, but their income's gone up significantly. So for most people, the answer is actually worse. Their income went up, but so did the house payment, the car payment, the subscriptions, the vacations, the credit cards. So I'm going to go back to the Dunedin study that found that people with low self-control accumulated more credit problems regardless of how much they earned. I'm going to emphasize that. Regardless of how much they made. Income wasn't the variable. Behavior was. Lifestyle isn't something that happens to you. It's a default setting. You have to actively opt out of it. And you got to say, I am going to live below what I make. So most people get their first real paycheck and immediately upgrade their life to match that paycheck. And then every time they get a raise, they do it again and again. And 20 years later, they're making great money, but they have nothing to show for it. So you want the simplest rule that nobody follows? Wealthy people follow this. People that are struggling don't. You ready? It's easy. Spend less than you make. It's the whole rule. Now, infinity investing, I use something called a 70-30 rule. You live on 70% and you deploy 30% towards other things. We actually give it 10% here, 10% there. Dave Ramsey's, the 10,000 millionaires, like this is 10,000 millionaires, people that are millionaires in the United States. The majority of these people lived below their means for decades. Some of these people never broke $100,000 a year. They just had modest houses, a lot of them used cars, no flashy spending. They weren't on Meta and Instagram trying to impress everybody. And I mentioned teachers were the third largest group of millionaires in that study, not because of their salaries, but because of consistency and that 70-30 discipline applied over time. They lived off of less than they made. They had automatic savings, usually in a 401k or a pension plan or some sort of retirement plan tied to their teaching. They did what they loved, and it compounded over time. They're a great example. Wealth isn't about what you make. It is about what you keep and you put it to work. So, Claude's advice: pay yourself first, make your money work for you, avoid lifestyle inflation. It's not wrong, but it's just giving somebody a gym membership and calling that the fitness plan. The destination is right. The system to make it actually work is missing. So I'm going to bring it back to the Dunedin study one final time. 1,000 kids, 30 years. The single biggest predictor of who ended up wealthy wasn't IQ, it wasn't family money, it was self-control. And the good news, self-control is a system, and systems can be built. Even in the study, they showed it could be learned, although learning by 3 was the best. If you had self-control by the time you were 3, when you were a little kid, it's definitely coming from your parents. You're not toast. You're great, but it could still be learned later. So the 3 things that actually move that needle, that will have a huge account, a big difference, and this is where I vary with Claude, right? Number 1, use the right accounts. Use the wealth machine the IRS built you. And I say that tongue-in-cheek, because IRS doesn't write the laws, they just enforce. And Congress created all these rules. You could see the difference based off of these rules. The same $5,000 over 30 years, there could be a huge difference in what you actually amass and what you actually keep. And that is a huge difference in the final outcome. If I'm paying tax as I go, and I am literally paying tax every year on investments, I'm an active investor, I've decided I'm going to be a day trader or whatnot, even though 95% lose money. But whatever the case, if I am investing consistently in a regular old savings account or whatnot, I'm going to be around $500,000 if I invest $5,000 over 30 years at a return. If I have cash tax drag, let's say that instead of making 10% a year, I'm making 8% because I'm paying tax as I go at ordinary rates, if it's short-term capital gains and things like that, versus over $1 million in the HSA. So that can be it could be a $500,000 difference on this type of investing. And remember, I only put in $150,000. That's the $5,000 that I put in every year. So it has a huge different impact on your final outcome. Right investments, set it and forget it. Let time and compounding do the work. Remember, the pros can't beat the index 90% of the time anyway. You shouldn't try to do that either. The right spending ratio, I suggest 70-30. Doing it every month without exception. 70-30 means you live off of 70% of what you take home. And remember, teachers retired richer than most people. Now you actually know why. It's the self-control thing. It's to set it and forget it. So what is your best advice to folks if you were asked the same question? If I said to you, what are the top 3 principles you believe will make somebody financially successful? Put it in the comments. I will say this though, if you write something like learn to code, I'm going to make fun of you. And if you want my framework, I wrote a book on it called Infinity Investing. It won a gold medal at the Global Book Awards and was an Amazon bestseller. And it actually works. It's yours free. I'll give you the e-version absolutely free. My only ask is that you share it with somebody and subscribe to my channel. That's all I ask. I'm not going to ask you to do anything else. I'll put it in the show notes, or you can write free book down in the comments and we'll send you the link, but it'll be in the show notes too. Please, if you like this content, and by the way, I publish a few videos a week, so if you like this content, do me a favor, hit the like button, subscribe, and plug in. And if you like this type of content, I'll even leave a couple of suggestions for you at the end of this video. Good luck to you.